Hey, good afternoon once again, Market Rebels. Happy Thursday, everyone. Last I checked, I think we were down 0.5% or so on the SPY. Not surprising after last week's rallies, but we'll have to see what the rest of the week brings. But we've always been talking about volatility. That's always been an underlying theme. And so today we want to cover a really special topic. But before we do that, I have a couple of little housekeeping items. Starting next week, we are only going to 1 day a week for trading tune-up. That's going to be on Monday, so Halloween of all days will be our last, at least in terms of doing 3 a week. I'm just going to do it on Monday next week. However, in its place, we have on Thursday a new show we're going to do called Coach's Corner. And there I'm going to bring up, mix and match from 1 to 3 of our world-class trading coaches. They're going to be options, topics, of course, but it's going to be more about how you would coach people into making the right decisions, or how do they fall into traps with these strategies. And we'll actually have those coaches on. So it could be anywhere from 1 to 3, just kind of mix and match. They'll be a little bit longer, probably 20 to possibly even 30 minutes. So be sure to join us on Thursdays, 4 p.m. at the closing bell for Coach's Corner starting next week. So for this week, this is our last of at least for 3 days a week. We have one more tomorrow. But for today, we're going to talk about one of my favorite topics, which is, see if we can get the slides to advance. There we go. What are the chances? And the reason I like to talk about this is that I have found that so many times traders during volatile markets like to turn to writing options. Partially true because they understand there's a high implied volatility, but where they usually step into traps is they'll say, oh, well, the stock's trading at 600. I'm going to write this $500 put. What are the chances that the stock hits there by Friday? You'd be surprised. And this is one of the things that you have to understand as a trader to at least get a handle on what's the potential range for a stock. All right, so that's what we're going to talk about here. And to kick things off, we have to go back to our friend, the bell curve, which many of you remember from statistics. But a lot of things in the sciences, like if we took heights of people, or at least heights of adult males, I should say, or of adult females, they would fall into a bell curve. There's a center where most people fall. And as we deviate from that center, whether taller or shorter, we tend to taper off. And then when you get into the super tall or the super short, they're there, but just the proportions are very, very small. And that's what happens a lot in statistics. So many things follow a bell curve. And what makes this practical is that regardless of the shape of this bell curve, that is the height or the width of it, which we'll talk about a little bit more in a moment, there are certain characteristics that always stay the same. And one thing is that this center portion right here, it's called a 1 standard deviation area. Don't worry about where the name comes from. It's not really that important. But 68% of your observations are going to fall into that center portion that I've got color-coded as blue. All right, so roughly 2 out of 3. 2 standard deviations is going to be the blue plus the gray, and there we're going to have 95% of our data, or roughly 19 out of 20 observations are going to fall into the 2 standard deviations mark. And then finally, 3 standard deviations will have almost all of your data. Roughly 99.7% of your data. Now, don't get fooled. A lot of times people remember something called the empirical rule in statistics, which is basically what this is, talking about the 1, 2, and 3 standard deviation marks. Those standard deviations keep going. There's a 4th and a 5th and a 10th and a 20th. But really, after the 3rd standard deviation, as you can tell here, the probabilities drop off so fast, it's just almost not even worth talking about. So we can get a pretty good handle on what we can expect if we can understand where the center of this curve is, called the average, or in statistics they call it the mean, and the width, which is the standard deviation, or in trading terms, what we call the volatility. What statisticians call the standard deviation, traders call volatility. It is exactly the same concept. It just shows us how wide that curve is, and that's important. So here's IBM over the past roughly 5 years, and you can see that it holds roughly a bell curve. And what we're looking at here are what are called the returns. And by a return, I'm just talking about the percentage change from one day to another. So if the stock closed at 100 and today it closed at 101, we would say the return on that stock for that day, the one-day return would be 1%. If yesterday was 100 and today it closed at 99, we would say the return is minus 1%. If we're getting positive, we're starting to build the right side of that bell curve. If we're getting negative, we're starting to build the left side. And you can see that they are roughly symmetrical. And there's your bell curve. So because of this, we can get some interesting insights into probabilities. So here I've got a tall, skinny curve in red. All right, now the current stock price will always be the center of the curve. So that's real easy to figure out. So here the stock is currently trading for 100. And if we get a very tall, skinny bell curve, it's a low standard deviation or low volatility. So maybe like a 20% volatility or 15% would be really low volatilities. If you start getting shorter and wider bell curves, you are getting into higher volatilities. Okay, so the lower standard deviations, lower volatilities just mean that there's not a lot of room for that stock price to move. Yeah, they can move up and down, but not all that far. When you start getting into the short, wide bell curves or the high volatilities, what we're saying is that there is a very wide range up and down where that stock price can move. All right, so those are really the basics that you need to understand. So how can you use this? Where does the practical application come in? Well, let's take a look at how we interpret volatility. Let's say that we have a $100 stock with 20% volatility. Most of your brokers' platforms are going to show you right on there, 20% volatility. If you have an option that shows you the implied volatility, that would be the volatility you'd like to use. So how do we use that number? Well, volatility, just like an interest rate, is always stated as an annualized number, even though it might have been measured over the last 30 days. We pretend that it's covering a full year. And so if we have a 20% volatility, one standard deviation move is 20% of the current stock price. So if the current stock price is 100, 20% of 100 is $20. There you go. It's really that simple. And from there, we go back to our little rules here. We know there's a 68% chance, one standard deviation, that the stock will be somewhere between plus and minus $20, somewhere between 80 and 120. Now, of course, this is at the end of the year because we're using that full volatility number. There's a 95% chance that the stock will be somewhere plus or minus 2 standard deviations. So if one standard deviation is plus and minus 20, 2 standard deviations is plus and minus 40. Or you could also take the previous range, 80 and 120, and either add another 20 to the top side and subtract another 20 from the downside. Different way of looking at it. Either way, you're going to figure out that range becomes 60 to 140. So notice, because we're widening the range, that we now have more confidence that it's like casting a wider net. We now know we're going to capture more stock prices. So there's a 95% chance that the stock in 1 year will be somewhere in this range. And then finally, there's essentially all, 99.7% chance that you're going to be within 3 standard deviations. So that's just plus and minus 60. So another way to think about this is that if you had 1,000 stocks exactly like this, they all started at $100, let's say on January 1st, they all had 20% volatility. We know that roughly 68% of those, or 680, would be somewhere between 80 and 120 at the end of the year. We know that roughly 95%, or 950, would be somewhere between 60 and 140. And we could be almost 100% certain that all of them would be somewhere between 40 and 160. Now, it's important, super critical to understand this. When we put these numbers on here, the only thing that we are assuming is driving the stock's price is this drift. Just this little bit of, we jump up a little bit one day, down a little bit, just this random, kind of a random walk to the stock. We're not saying that the $100 stock gets bought out for 150 next week and saying, therefore, the math is wrong. We're not talking about acquisitions, mergers, anything like that. We're just talking about the day-to-day volatility drift that we measure in this thing called volatility. That's the ranges right there that we could expect. Now, if we want to scale it, because most of the time we're not worried about what's going to happen in a year, how do we scale it? How do we jump to a different time scale? Unfortunately, like with interest rates, it's easy. If you know that interest rates are 8% for a year and you want to know what they are in 6 months, you cut it in half. It's 4%. If you want to know what it is for a quarter, you cut it in half again, it's 2%. It's very easy to scale interest rates. It's not that easy with volatility. And that's because volatility moves with the square root of time. Wouldn't you ever think you're going to use square roots again, right? But here's the thing. There's a couple of different metrics that we can use. We could say that there's 360 days in a year, and then we could also say that there's 252 trading days. Take your pick. For the most part, unless you're talking about really short-term options, it's not going to make a bit of difference. But most people use the 360 method or the 365. And the reason for that is that most brokerage platforms will show your days to expiration in this format. So if they say there's 37 days till expiration, they mean 37 calendar days. So for that reason, a lot of times traders will just use the 360 method just because they can grab the time to expiration right off their broker's platform. But other than that, it doesn't really make a big difference. So let's talk a little bit about scaling volatility. Here's the way you're going to do it. It's actually quite easy. For a day, how big is a day? It's 1 divided by 360. But we can't just do that. We have to take the square root of that number. So just pull out a calculator, 1 divided by 360, and then hit the square root key. And you should get, I've only gone to 2 decimals, roughly 5%. And what that means is we're going to take that volatility number, that annual volatility number, and take 5% of it. Just multiply it by 0.05. It's going to knock out 95% of that value. So if you've got 20% annual volatility times 5% is going to take you down to roughly 1%. All right, what if we wanted to know for a month? I've got a 30-day option. How far can this stock price drift in a month? Well, how many months are in a year? There are 30. I'm sorry, the monthly, we're looking at how many days are in a month. We're looking at 30 divided by 360. Or we could say how many months are in a year, 1 divided by 12. It's the same thing. But we don't just take that number, we take the square root. And that's going to give us roughly 0.29. So now we take that annual volatility, we just multiply it by 0.29. And we're taking 29% of it. All right, and then we're going to use exactly the same math. What if you want to look at a quarter? There's 90 days in a quarter out of 360. Take the square root, and there it is, a half. See, with interest rates, we divide by 4. For options, because of the square root pricing rule, takes 4 times as much time to double the options price. So when we go to quarterly, it's going to knock your volatility in half. So again, if we had 20% volatility, we would actually pretend that it's just 10% and then do the same calculations. So let's try one with monthly. Let's go back to the same example. We have a $100 stock, 20% volatility. One standard deviation is 20%, but we can't use 20% because we're not worried about what's going to happen in a year. We're trying to figure out what's going to happen in a month. Based on what we found on the previous screen, 0.29. We multiply that number by 0.29, we get roughly 0.06. And from this point forward, it's exactly the same. One standard deviation is 6% of 100 or $6. Now we know there's a 68% chance you're going to be plus and minus $6, or a low of about 94, high of 106 at the end of the month. I know I'm about 95% certain the stock's going to be plus and minus 2 standard deviations, or somewhere around 88 to 112. And then finally, I'm going to be virtually 100% that stock will be somewhere between 82 and 118, or just 3 standard deviations, or 3 times 6 of 18, just plus and minus 18. So it's really just that simple. Now, there's a little trading tip if you want to use daily. I know I just said that most traders are going to use the 360-day method, but there's a trader's trick that we use for converting to daily volatility. And here we're going to switch. That's assuming you're using the 360. We're going to switch over to 252. And what we're going to do is to round up to 256. And the reason that we do that is if we take the square root of 256, we get this nice round number of 16. So now all we have to do is to take the annual number and divide by 16. Now, yeah, in the previous examples I was multiplying, you can multiply by 1/16 if that's easier, and you can divide by 16 probably faster in your calculator, right? So let's try a daily one. Here's our $100 stock, 20% volatility. This is what we got from our broker's platform. You want to know how far this stock can move up or down in a day. How do we do it? 20% divided by 16 is 1.25%. Now run through the same numbers. One standard deviation, $1.25. Therefore, there's a 68% chance the stock is going to be somewhere between plus and minus $1.25, or roughly about 2 out of every 3 trading days, a $100 stock is going to fall in this range. 95% of the time, or roughly 19 out of 20 days, you're going to get 2 standard deviations, or 250. You'll be somewhere around 97.5 up to 102.50. And then finally, you're virtually 100% certain that at the end of the day, a $100 stock would be somewhere between 96.25 and 103.75. Now, why is this important? Does it really mean that you have to pull out a pen and paper and Excel or whatever and do calculations? Probably not. My main message here is to understand, for those of you who have brokerage platforms that show you these numbers and these ranges, have great appreciation for what it's telling you. So for example, those of you with Thinkorswim, okay, here's what's called the probability of expiring cone. You can find it under your studies and under volatility studies, and you'll see probability of expiring cone. We can set this however many candles we want into the future, and it will show you at various dates the high and the low. So right now, this was just shot today. Microsoft at the time was about 226. There was about, I'm sorry, that should have been 100, and I think it was 182 days to expiration. And the high was 226, and I don't know what happened to my low down here, but it's about 165 is the low. So the point is that now you've got kind of a good range. Should I write those naked puts? Should I write those naked calls? I mean, just how high can this stock get? It's usually a much bigger range than traders give it the due respect that they should. And so that's one of the main reasons for understanding just about some of the math behind the stock price probabilities. So next time you're wondering what are the chances, hopefully you now have an easier way to answer that question. And so these are the things that we like to show and help people to make better decisions. Remember, it's not just about what you know, it's about what you don't know. And so to go from good to better to best, it does require training, no matter what your level is. So for anyone who'd like to get additional training, we are offering a free, yes, you heard that right, free 30-minute one-on-one consultation with one of our world-class coaches, ones that will be on starting next week. And the phone number there is 888-809-8058. Okay, that number again, 888-809-8058. Give them a call. You can set up a free consultation, pick a topic, and you'd be surprised at what they can teach you in 30 minutes. So again, I hope that helps, gives you something to think about. That's really what we're trying to do here with each of our sessions at Trading Tune-Up. Again, we will have at least our last Friday session tomorrow. Starting next week on Halloween, we will go to 1 day a week on Mondays for Trading Tune-Up. And please join us next Thursday, 4 p.m. Eastern on the closing bell for our first show of Coach's Corner. And I look forward to seeing you then. Thanks so much.